Morning, everybody. It is Saturday, and this is Multifamily Unplugged, your raw, unscripted conversation about multifamily and raising capital. Hope you are doing well and enjoyed your week and looking forward to a great weekend here. I'm excited about my guest today, Jonathan Catani with Catani Capital Group. I was on his program a while back, and now he is returning the favor and being on mine. And I think you're going to get a lot out of today's episode. There's no doubt about that. But if you are new to the show, welcome. I would love to just ask you if you would just take a minute and connect with me on social media, wherever you hang out, Instagram, Twitter, LinkedIn, wherever that might be. Find me, Mike Morawski, or My Core Intentions, and get connected. Hopefully you're live streaming with us from YouTube. If you are, subscribe to our channel there. And remember, I always talk about intentionality, right? Being intentional about how we start our day, how we begin our day, whether it's the weekend and you're spending family time, or whether it's during the week and you're getting ready to find another seller to buy a deal, to go talk to somebody about raising equity, about underwriting, whatever you are being intentional about. It's important that we look at that every day. So, hey, if you have something that you're being specifically intentional about, drop it in the comments today. Love to hear from you, where you're at, who's here. Don't forget, use that comment box. If there's questions, we'll try and get those answered on the show and go from there. This show is brought to you today by My Core Intentions. And remember, the Multifamily Summit is coming up in October. The biggest virtual event of the year, 3 days, over 20 speakers are going to share one stage. So you're going to get a variety of information. We're going to have a securities attorney on this year. We're going to have a number of people talking about multifamily. Stephanie Gutierrez is going to talk about ADUs. We're going to have Bronson Hill talking about raising capital. So we're going to have a vast array of speakers on the stage. Get registered for that at mycoreintentions.com/summit. And you will grab a VIP seat and join us and have a great 3 days. And you know what? If you're not there, it'll be recorded. We'll get you a copy of it. So I look forward to seeing everybody there, though. Hey, my guest this morning joins us from Salt Lake City, Jonathan from Catani Capital Group. Let me bring him in and we'll get started. Jonathan, good morning.
Good morning. Happy Saturday.
Yeah, for sure. Thank you for that. How's it going?
Doing very well. Good.
Hey, I always like to start my show with one question of all my guests. And I always say I'm going to write a book about this. And one of these days I actually am, but I'm going to take all the words that people say and just write a page about it. But in one word, what best describes you personally and professionally?
I'd probably have to say ambitious.
Where's that come from?
I've always just, as cliche as it is, but, once I set my mind to something, I really am not going to stop until I accomplish that, which, really feeds well into being an entrepreneur, because you're, especially in the beginning, you're more of a solopreneur, right? So it's really up to you for self-discipline and kind of that motivation to get started, take that leap of faith, and then, really build your business.
Yeah. Awesome. A few weeks back, I was on your show and, we shared a little bit about you and your story and your journey. And I'd love to share that with the listeners today, just letting them know a little about you. Why don't you talk about your background a little bit?
Yeah, absolutely. So moved to Salt Lake when I was 16. I'm 32 now, so been here exactly half my life. Graduated high school, was a small town. Now it's a bustling metropolis. You barely recognize it. A town called Lehigh. And ended up, went to college. Didn't actually end up graduating college. School was not for me, at least back then. My priorities as a 18, 19-year-old kid were different than they are now, as I'm sure a lot of people can relate. So I bounced around, worked for a family business. There's construction business on my mom's side, worked there for a while. Ended up though actually getting a job as a stockbroker for E-Trade here, which is, obviously a discount brokerage. So I got my Series 7 and my Series 63, and that was my first intro, real deep dive into finance aside from, kind of my general ed classes. And I was immediately hooked. I absolutely loved it. It was so much fun learning about it, talking about the stock market, understanding how it worked, the different dynamics, derivatives, all the things that encompass it. And I worked my way up to high net worth clients. There it was basically anyone who had 5 million or more in assets at E-Trade. And essentially what I ended up seeing was a pattern of a lot of, alternative assets, which those on Wall Street call them. Here we call them the smart investments. But I did a lot of paperwork for my high net worth individuals and getting them in their IRAs and self-directed 401ks to invest in real estate assets, and started talking to some of them, really, getting an idea of what they did, why they did it. And, that led me, of course, to, I think, what most real estate entrepreneurs can attest to is the Purple Bible, Rich Dad, Poor Dad. And from there, it led to books and podcasts. And, I dabbled in some other things, of course, wholesaling. I never did a fix and flip, but I followed a fix and flipper around. That's all it took for me to know I didn't want to do that. I'm not the most handy. And, but what I always noticed was, a few terms, right? You had economies of scale, all those different terms. And I was like, okay, where is that? Well, it's in commercial real estate. And so I realized pretty early on that that's what I wanted to get into. So, long answer to a short question, but essentially it led me to jump in with a firm last year, 2021. And, they were just starting out. They had just actually done a development deal here in Utah, 70 units, townhome style. And they wanted to grow. And the markets they want to grow in were Columbus and Oklahoma City. And they needed some help on some back-end stuff. So I was able to jump in and help build their CRM, their email, all of their automations, ebooks, lead magnets, you name it, right? I had my hand in it in some form or another. And we scaled in about 10 months from 70 units to 572 units. So as you can imagine, it was just a rocket ship, right? Tons of traveling, looking at deals, brokers, dinners, you name it, right? And I was hooked. I was like, this is it. This is what I want to do. And identified that capital raising was probably one of, and this is a very subjective opinion, but capital raising is probably one of the number one skills you can have in this industry. And it just so happened that I had a network of investors already, friends, family, past clients, and immediately jumped into Raise Masters, which is Hunter Thompson's capital raising mastermind. And from there, use that as the foundation to build my business, Katani Capital Group, and, begin my capital raising efforts and, primarily staying on the passive side.
Yeah. Interesting. Very cool. So, God, you really got my brain churning this morning already. It's way too early for this, but so I have to ask you about your opinion around diversification in a portfolio. Okay. And I'm talking about that traditional side versus, alternative investments like real estate and gas and oil. How much, when you look at it today with your background and knowing what you know about, traditional stocks and bonds, how much of a portfolio should be diversified, say real estate and stocks and bonds? Do you believe in diversification, or are you heavy to one side? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
Yeah, great question. I absolutely believe in diversification, delineated all the way down to geographic and diversification, which we can get to. But diversification in the stock market is a loose term, right? You talk to a financial advisor, he's going to tell you, we're going to, depending on your age, right? We'll use me, for example, right? Maybe 12 to 15% in small caps, and then some mid caps, and then some large cap blue chips. And, you could consider that diversified, or, maybe a tech fund and an energy fund, and, maybe something counter-cyclical like utilities, right? And you call that diversified. And, technically speaking, yes, that is diversified. But in reality, how diversified are you, right? The market really correlates, all of those correlate in some form or another, right? And, when the market's down, the market's down. There's really, of course, there's some things you can be in. There's some things that will stay up, right? But a drop like we just recently had, the drop in 08, even the drop in, Q2 of 2020 from COVID, the market was down, right? It didn't matter what you were in. And certainly, those of us who are set up well use it as an opportunity. But in reality, you're not really going to get the diversification like you can in alternative assets. And with those, you have, an array of asset classes, right? You obviously have multifamily, you've got self-storage, you've got office, you've got retail, you've got industrial. Those even delineate further. You've got suburban office and suburban retail. You've got your A, B, and C class multifamily. You've got your A, B, and C self-storage. And then you can go even geographically, right? So you can do your Sunbelt states. You can, the Midwest. You've got, the West, my area, California. So when you really break down the diversification opportunities in alternative assets, you can really see that it actually presents a much better opportunity to be diversified. And then, oh, by the way, you can do cash flow, you can do appreciation, And so when you take all of that and you put a little bit of each of it into a portfolio, that's true diversification, in my opinion.
Yeah, absolutely. I agree with that. Just as a little side note, I'm a huge Tony Robbins fan, have been for years. He wrote a couple of books actually on money. One most recent was Unshakable, and he talks a lot in there about the S&P indexes. Any thoughts around that?
He's a big stock market guy, right? I've listened to a few of his talks, and he talks about, over the last 30 years, if you've been in the market, your returns are X. If you've only been in for 20 years, they're X. And right in it, and it decreases the less you've been involved in the market. And that is true. There is something to be said about it. It's not to say I'm not completely in the stock market. I still am. I do think there is something there, but I just think on a risk-adjusted basis, if you don't know anything but you want to be in the stock market, then yes, index funds are absolutely where you should play. By no means am I an advisor, so please don't take this as advice. Yeah. But for the general person who wants to be involved, who wants to understand it, and I think everybody should have a basic understanding, yes, I do think index funds, S&P. If you were only to do 3 funds and they were just the S&P, the NASDAQ, and the Dow, you would honestly, over a 30-year period, enjoy very, very nice gain.
Yeah. Yeah. And yeah, let's pre-emphasize that we're not attorneys. We're not stockbrokers. We are not accountants. We just are having a conversation here this morning. That's it. So the other thing you said that and I really like this, you said that capital raising you think is one of the most important, if not the most important functions of multifamily syndications. And, I agree, right? I mean, everything you and I do is a function of capital, right? But if you were to look at capital raising and underwriting, because to be a good capital raiser, I think you need to know how to underwrite, because you need to be able to talk about the numbers, right?
Absolutely.
So, but do you play one against the other? I mean, do you think one is more important than the other?
That's a loaded question. I think it depends. They're both equally important in the overall grand scheme of the deal, right? And it's kind of a chicken or the egg thing, right? Because a capital raiser is not going to have a deal to raise for unless the underwriting's done well and you're able to identify a good deal, right? So in that sense, underwriting is very important. But on the flip side, there are people who are incredible financial minds and underwriters who wouldn't dare jump on a call with an investor and, try to talk to him about a deal, even though they're the ones who underwrote it.
Yeah.
So they're very symbiotic, and certainly, they are far better underwriters than I am. I learned it and do it for the reason which you just outlined, is that it's very beneficial, because you are going to talk to investors who have been doing this for years and want to dive deep into the numbers. And if you can't break down the numbers for them, then, they're not going to invest in your deal. So from that sense, I have a good understanding of it, but by no means do I claim to be an expert underwriter, nor an expert capital raiser, although I do think my capital raising skills are better than my underwriting skills.
Yeah. And, the math never lies, right? So underwriting, I think, is one of those things that, you've got to know it in order to be able to go out and capital raise, because people want to know, how'd you get this? Where did this come from? How did you estimate your rent growth? How'd you estimate, and I guess I'm fortunate because I have some construction background, right? And, even though it was years ago, I still get it. And pricing has changed, but you got to look at it differently. But so, yeah, capital raising is, and the other piece around that is the relationship building. So you got to like people, right? You got to like to be able to meet people and get out there. So talk about that a little bit. Talk about some of your best capital raising techniques. What do you?
Yeah. So one of my sort of, I guess, unique abilities, superpowers, whatever you want to call it, is my ability to pretty quickly in a conversation get someone to be talking about themselves in the sense of their passions, right?
Mm-hmm.
I'm very passionate about what I do. So I love to bring that out of people. Hey, what are you passionate about? What do you do? Why do you do that? Do you like, right? So asking questions, open-ended questions, and getting people talking about themselves is absolutely crucial. Because, no matter what anyone tells you, whether you're talking to one of the most sophisticated investors or a first-time investor, they're going to invest based on emotion. And if you're not invoking the correct emotions, then they're just not going to invest, no matter what the numbers are, which is why you can't send an OM with a, 3x multiple and an 8% pref and to your uncle and them just be like, oh yeah, sweet. I'm going to invest in this deal. Right. If so, then, my job would be very, very simple and everybody would do it. So you have to figure out, what they're passionate about. And really what that's going to lead to is why they want to be and why they want to invest. And then, what they want to get out of it, right? What, do they want financial freedom? Do they want, just a little passive income? And really figuring out, what their goals are and doing it in a way that doesn't make it sound like you need them, right? Like, hey, this deal's going to oversubscribe without you. And that may or may not be true, but you really have to encompass that, because if they get a sense of desperation, right? That's why they tell you that you should be raising before you have a deal, because if you're desperate for capital, they're going to sense that, especially a very sophisticated investor.
Yeah, 100% mindset, I think, and you kind of alluded to it. And then my whole mindset is really important, right? And I like your approach, because it's like, I'm humble, but I'm yet, I know I don't need you, right? And I've enjoyed it when I've been able to tell an investor, I don't think you're right for this deal, okay? Because I think when an investor comes to you and they want you to change operating agreements or PPMs to suit their language or their need, that just creates a lot of havoc for everybody involved. And I've learned over the years that doesn't make sense. You mentioned 3x multiple, right? And I find that kind of intriguing today in the market where we're headed into. We rolled a deal out last year, brought a deal to market that was a 2.6, and I had to double check and triple check it. They say as a carpenter, you should measure twice, cut once. And I was kind of a surprised at 2.6 multiple, but where are you seeing deals today? Are you raising on anything? And, how's underwriting getting done in your space today?
That's a great question. It's changing what feels like daily. And if, you're involved like we are, it almost feels like hourly. The double and triple check is more important now than ever. So I am raising right now. I'm actually raising for a portfolio deal. So it's actually 10 multifamily assets across 7 southeastern states. It's an appreciation play, right? So it's not for everyone. And this goes back to what you were just saying. Understanding what your investors' goals are is so important, because I'm not going to send this to every investor, right? If an investor wants cash flow, this is not the deal for them. So there's absolutely no reason to even send it over to them. It's a 5-year hold, projected, 3.9x multiple. So it's a fascinating one, for sure. It's obviously a large deal portfolio. You don't see deals like this often, nor do I typically even entertain deals like this often. And I'll tell you why, because a deal like this, there's a lot of margin for error when you have that many assets at once. And unless the operator has the infrastructure, and I don't mean like, oh, hey, we have 10 other assets in our portfolio and now we're ready to double our portfolio in one deal. I mean, like, they've done this before and they understand what goes into it. And they do. They've got close to $3 billion in assets under management. They've got 40 years of experience. And so for me, it starts with the operator first and foremost before I'm even looking at a deal, right? I've got about 110 point checklist that I go through. It includes a background check. Obviously you want to meet with them in person is the most ideal. I know a lot of stuff happening over Zoom now. So you have obviously those obvious ones, right? Which, ultimately is one of the reasons that, my investors will come through me instead of, going directly to a deal, right? Is busy professionals don't have the time to do that. But this is an anomaly deal. By no means am I seeing deals at 3.9x. I think it's like a 30+% IRR. on a five-year hold. So on average, you're honestly seeing, a lot more conservative deals now with interest rates being the way they are, cap rates still compressed, maybe ticking up a point, maybe 50 bips, depending on where you're at. And so what you're seeing is more like, 1.6 to 1.8x or, 2x multiples. You're starting to see 6, maybe 7%, preferred returns. So you're really starting to see your returns diminish, which is natural, right? I think investor sentiment needs to, and I think it'll take some time. I think we're getting there, but I think investor sentiment is still stuck 3 years ago when you were, getting 2x in 18 months and, 8% return and 16 to 22% IRR, all done in 18 months, right? Unfortunately, that's just not going to be the case anymore. You're going to see long-term debt, right? This portfolio deal has a 10-year fixed rate. So you're going to start seeing a lot more of that, a lot less bridge debt. And so, the conversation with investors is going to have to help them understand that those days are gone for now. They'll be back. Everything goes in a cycle, and we just happen to be at the point in the cycle where, things are turning the opposite direction, but there's still a lot of good economics in our favor. We're still very undersupplied as a nation. You obviously have your top markets, which are still seeing, very nice growth. I know Texas, Florida, a lot of your Sunbelt states still enjoying very nice rent growth, despite the changing landscape. And so I really think, you're just going to have those conversations with your investors. If you are an investor, doing your economic research or talking to someone in your network who understands that, and just realizing that, you may actually be in the deal for the whole 5 years instead of, these 18, 14-month turnarounds that we kind of saw there for a little bit.
Yeah. I think those are going away for sure. You mentioned a 6 to 7% preferred return. For people that don't understand that, that's that cash on cash return that you would receive along the way, but that would be inclusive of an overall IRR. If 6 and 7% is going to become the new norm, what do you think? What are you looking at IRR wise for the investor? Not deal size, but what do you think is acceptable to roll out for investors today?
I mean, I think if you're in the mid-teens IRR, I really don't. If your underwriting is conservative, you're a strong sponsor. I really, to me, that is a solid deal, right? We got spoiled there for a long time. And
but you said it'll be back too.
And it will be back. And
so you're at the tail end going in the front end. You're going to come out at the tail end of this thing.
Right. And I just, to sit in cash right now, I understand those who want to wait a little bit. I know a lot of people are waiting for Q4. I'm not sure what the magic of Q4 is, but just talking to some institutional people, that seems to be what they're waiting for. I know there's at least one more rate hike coming. I think it's another 50 basis points here in September from the Fed, which I think that what they're really waiting for, if I understand correctly, and I'm not an economist, although I pretend to play one sometimes, it is probably one of my favorite things is economics. So, but I think what's going to happen is in September, you're going to see another 50 basis point hike, and then you're going to have a really clear outlook of what's going to happen, what the Fed foresees happening. I think this year, especially, they don't really know. They're really trying to slow things down, and that's all they know right now is just, hey, we need to slow inflation down. Whereas I think come September, when some more stats have come out, and I think inflation will tick back down again for August. I think you'll see a clear outlook. And then I think what you'll see is you'll start to see more people prepare and set up their business plan moving forward, investors included, right? I've talked to a few investors who are sitting on a good amount of cash right now and just kind of waiting. And although it hurts because it is technically burning with inflation, I'm not against it, right? You have to be careful when you do something for too long, aka sit on the sidelines too long. You get too comfortable on the sidelines and it's hard to get back in.
Yeah.
Right. Yeah. So you have to be careful and understanding where that balance is of, okay, I want to wait. But then if you wait too long, what are you waiting for? So.
Yeah, absolutely. And I think a lot of times it's fear that hold people back. They just, just want to wait but it's like anything else. You can't live your life that way. You've got to take action regardless, who's in office or what the interest rates are. I always say there's 2 times to plant a tree, right? 20 years ago or today, you choose. So,
yes.
Okay, so I have 2 questions, and the first one is I've heard this comment. I actually was on a panel at an event with a guy who said the first time in history that cap rates have been lower than interest rates, and that's a disparity in the marketplace. Can you talk about that at all?
Yeah, so it is fascinating, right? Because you are seeing some deals coming right out of the gate with negative leverage.
Yeah.
And, that takes a special operator and a special investor to want to take on that deal. But, again, with correct underwriting in the correct market, it's not a bad deal. It can work, which is why you're seeing it happen and why you're seeing operators take on these deals and investors invest in these deals. Again, it's going to be obviously a well-seasoned operator and typically probably going to be an investor who's invested with them already. But, it's tough, right? You're seeing, low 3s here in Salt Lake. We're seeing low 3s. And yet, it may sound outlandish to some, but I am not a very risk averse person. I'm very open to risk. So I think right now development has a pretty strong play in the correct market, right? Where you are seeing sort of that negative leverage, but because it's development, because you have all the yield on the back end, and it's done with a seasoned developer, and they're going to be vertically integrated, have their own construction, probably wholesale their costs, blah blah blah, all the way down the line. There's a very compelling argument for development right now, particularly in the self-storage space, which is where I'm seeing a lot of development still taking place. Now, on the flip side of that, you're seeing a lot of lenders putting their pencils down completely and not even entertaining it. So it's a difficult thing to navigate, and it's challenging when you want to get deals done and you just cannot because you've got this incredible delta, sometimes, 2, 3, 4 points in some markets.
So are you seeing is all your money that you're raising, is it domestic, or are you bringing in any international money?
Gosh, I wish that I could play in the international money. I've got some people in my network who do, but mine's all domestic.
Okay. And is it all private or institutional, or?
It's all private. Yeah.
Okay. So it's, $50,000, $75,000 investors.
Yeah, I've got some big check writers who can write, 250 to 500, depending on the deal. But, for the most part, yes, it's your 50 to 100.
And do those come from those types of check writers? Are those individuals or do they come like a group?
Those are actually individuals. Yep.
Okay. All right. Nice. Yeah. Because I know a lot of people do it different ways. So that's why. You have referred a number of times, and I think you even kind of just alluded to it again about the development piece, but the operator. You said you have a list of 102 things that you want to know about an operator or a sponsor, right? What, talk about your top three on that list. What do you want to know about an operator before you sign on with them to raise capital for them?
Yeah, great question. So especially nowadays, speculation or by that I mean jumping on with a newer operator is probably waning. In fact, I'd say it's probably, at least for me, gonna fall to the side until things change. So in that sense, I want to see, at least 10 full cycle deals. So that's probably going to be the same amount of years in the business. So you want to see 10 full cycle deals. How many deals, how geographically diverse are you? Are you only in one market? Are you in 10 markets? That's going to be a big deal. And then also one that's big for me right now is your infrastructure and your bandwidth. How much bandwidth do you have to take on this deal right now? Right. Do you have is your asset management team already spread super thin? Can they even bring on a new asset to manage, to stabilize and get up and running? So it's little details like that are really going to determine whether or not, I feel comfortable, raising for one of your deals.
Yeah. Interesting. Well, listen, I know that I think you have an ebook. You want to tell people about that?
Yeah, absolutely. You can go to my website. It's investwithkatani.com. Spelled obviously the same as Katani Capital Group. Ebook is called Is Commercial Real Estate Recession Proof? I wrote it in January, which is ironic because January was the top of the market now, looking back in hindsight. So I would like to pretend that I can claim that was incredible timing by me, but it was a bit coincidental, although I think we all kind of knew something was coming. So it really just breaks down the data from the last couple economic downturns that we've had and shows you why I think that commercial real estate is the most compelling asset and the most compelling investment in these downturns to carry you through.
Interesting. I'd like to read that. I'll trade you.
Okay, deal.
Hey, listen, this has been great this morning. I appreciate it. Let's lighten it up a little bit. I'm going to ask 3 bonus questions.
Sweet.
Best book you've ever read?
Wow, that's a great question. Holy cow, best book I've ever read. Right. So I'm not done with it, but I already know it's the best one, Principles by Ray Dalio.
Oh, love that book.
Yep.
It's one of those books you go back and you read it again and again. The thing, he's an amazing guy. I love to watch him on social media too.
Absolutely. Likewise.
Yeah. I remember, just a side note, I remember seeing him on 60 Minutes a number of years back, and I was just amazed. I was like, holy cow, and everybody gives a lot of kudos to Warren Buffett and Bill Gates but Ray Dalio's been a sleeper, so
he has kind of flown there under the radar, which is fascinating considering how instrumental he's been in our economy.
Well, it gives you and I a lot of to say, wow, that's a way he did fly under the radar, and that's interesting. So,
yep.
Best restaurant you've ever eaten in? They get tougher.
Oh gosh, that's a really, really great question. So I'll say recently. So we have one here. It's called Valter's. It's an Italian restaurant, only open for dinner. Usually 3 to 4 weeks out to even get a reservation. You know, and so every time I go there, it's just your ultimate fine dining, right? Which if you experience fine dining, you know how great it is. But the food is just, I mean, they prepare everything tableside, incredible ingredients, you know, great wine. They really, really take the time to make sure you understand, you know, what you're eating, you know, why this wine goes with this. And it's just, you know, experience and food wise, it's hands down the best restaurant in Utah. You know, celebrities come from all over to eat there, and you know, easily the best one I've eaten at in the last couple of years.
Well, we'll have to do a deal together, and I'll have to come out and
Yes,
have that steak dinner with you, or some pasta.
absolutely.
And then best tourist attraction.
Do amusement parks count?
Sure.
Because
roller coasters, go for it.
Yes, I love roller coasters. I grew up on roller coasters. I grew up in New Jersey. We had Six Flags. I even lived in Florida for a little bit. We had Universal Studios. So those will always be my number one. But in terms of kind of off the, you know, little different, I love national parks, and we have 5 of them here in Utah. So visiting national parks is definitely another one for me as well.
Well, awesome. Yeah. Listen, this has been great. Tell people how they get a hold of you again, if they want to reach out.
Yeah, absolutely. So best way is email. The email's kind of been scanning here. Jonathan@KataniCapitalGroup.com. That will go directly to me. Would love to hear from you, answer questions. You want to jump on a call, talk about anything. If you're an economics buff as well and, you know, want to talk economics, give me a call. But this has been amazing, Mike. Thank you so much.
Yeah, I appreciate it. And, you know, I really enjoyed talking with you last time, and this time even more, to dig into you a little bit more. You know, sometimes you get on with people and you go, man, where'd the time go? Right. And I kind of feel that way this morning, because it's like, you know, when you connect with somebody who's in your world and in that space, and the languages, you know, it makes all the difference in the world. So I appreciate you and your time, and look forward to continuing to build our relationship, and you know, maybe do a deal together. But I'm going to move you to the back room. If you'd hang out with me for a minute, I'm going to say goodbye and talk to you in a minute.
Absolutely.
Hey, everybody. Boy, I hope you enjoyed that this morning as much as I did. Jonathan Catani with the Catani Capital Group. Reach out to him if you are, you know, like he said, an economics buff, or looking for an opportunity for your private capital. You know, I'm not the only one out there. There's other groups out there, but just go and, you know, explore your options and take a look at what's around. You know, we bring this so that we spotlight some other individuals in the space that are doing great things. And Jonathan is really somebody to look towards. Again, a reminder, our Multifamily Global Summit is coming up in October this year. It is October 20th through the 22nd. It's a 3-day virtual event. Grab your ticket. It's going to be outstanding. We have 20 speakers this year. The stage is just going to be packed. People like Bronson Hill talking about raising capital, Stephanie Gutierrez talking about ADUs. We're going to have Brian Briscoe on, Abel Pacheco. So, you know, a number of people who, you know, who are around, who are in the space. Whether you're a brand new investor with no experience, come and learn everything you possibly can learn. Be a sponge, absorb it. Or whether you're a seasoned investor, you're going to get a great shot in the arm. But it's going to be 3 days of multifamily extravaganza, no doubt about that. I look forward to seeing you there. Go to mycoreintentions.com/summit. Get registered for that event. I'll see you there. Everybody have a great week. Remember, we'll be here next Saturday morning again at 10 a.m. Central. If you're new, tell somebody about the show. We'll always be bringing great content for you to help build your multifamily business. I hope you're enjoying this morning's show and guest. If you love getting content and insider secrets just like this, then you won't want to miss this year's annual Multifamily Summit. I will host the stage to over 20 of the nation's top multifamily owner-operators, where we will pour into you for 3 full days. This 3-day virtual event, October 20th through the 22nd, is committed to help you take your multifamily business to the next level. You will hear from speakers like Brian Briscoe, Abel Pacheco, and Bronson Hill, and many others. You're going to learn how to mitigate your way and succeed through the changing market environment. Register now at multifamily20.